At 8:42 a.m., your phone vibrates. A message from your bank. Not good news, not bad news, just a notification. Somewhere else at the same moment, a factory slows down. A cargo ship reroutes. A central banker clears their throat before speaking. None of this feels connected, but it is. There's an invisible chain linking your bank balance, your job security, and the next global crisis. You don't see it, you don't vote on it, but you live inside it every day. And right now, that chain is under tension. This matters now because for the first time in decades, ordinary people are feeling things they were never supposed to notice. Interest rates, liquidity, bond yields. Words that used to live quietly in the back pages of newspapers are now deciding rent, layoffs, and elections. This isn't about one country. It isn't about one crash. It's about how money actually moves through the world and why small cracks travel fast. So let's start small. With you. Your bank doesn't keep your money in a vault. Not most of it. When you deposit $100,000, the bank keeps a fraction and sends the rest into the system. Loans, bonds, government debt, corporate promises. Your money is working while you sleep. And while it works, it becomes dependent on everyone else behaving. This system was built on trust, leverage, and timing. And it works beautifully until it doesn't. Here's the simple version. Banks borrow short-term and lend long-term. They take deposits that can be withdrawn today and lend them out for years. Mortgages, business loans, infrastructure. As long as withdrawals are slow and predictable, everything is fine. But if confidence breaks, even briefly, the math collapses. This isn't a theory. We've seen it before. In 2008, people didn't suddenly stop paying mortgages. They stopped trusting the system that priced them. What followed wasn't just a banking crisis, it was a chain reaction. Banks froze lending. Companies couldn't refinance. Jobs vanished. Governments stepped in. And that intervention changed everything. To stop collapse, central banks flooded the system with cheap money, near-zero interest rates, trillions created digitally. The logic was simple. Keep the chain moving at any cost. And for a while, it worked. Asset prices rose, stock markets boomed, real estate soared. But something strange happened. The economy recovered unevenly. Capital got cheaper than labor. Money flowed faster than wages. The system survived, but it mutated. Now, fast forward. Inflation returns. Supply chains snap. Energy prices spike. Geopolitics re-enters the room. Suddenly, cheap money isn't cheap anymore. Central banks raise rates to slow inflation. Sounds boring, but this is where the invisible chain tightens. Higher rates mean borrowing costs rise. Governments pay more to service debt. Companies delay expansion. Banks reprice risk. And quietly, jobs become numbers on a spreadsheet again. Here's the uncomfortable math. Most modern economies run on debt. Government debt, corporate debt, household debt. Debt only works when growth outpaces interest. When rates stay low, debt feels harmless, even helpful. But when rates rise, the same debt becomes heavy. Imagine running uphill while the ground tilts backward. That's what happens to economies during tightening cycles. Now zoom out. Your bank is connected to government bonds. Government bonds are connected to central bank policy. Central bank policy is connected to inflation and geopolitics. Geopolitics is connected to supply chains and energy. Energy touches everything. This isn't a conspiracy, it's plumbing. And plumbing doesn't care about ideology. Here's where the irony lives. The system is marketed as stable, predictable, managed by experts. But it's built on assumptions that break under stress. Assumptions like markets are rational, risk is priced correctly, shocks are temporary. Reality keeps disagreeing. When something breaks in one corner, money doesn't panic loudly, it retreats quietly. Liquidity dries up, credit conditions tighten, banks lend less even if they say otherwise. And the first people to feel it aren't traders, they're employees, contractors, small businesses. Your job is downstream of global liquidity. That's the part nobody says out loud. Now let's talk about hype versus reality. You're told that markets reflect fundamentals, that prices incorporate all information, that long-term thinking wins. But markets also chase yield. They follow incentives. They respond to fear faster than reason. When rates were near zero, risk looked cheap. Speculation exploded. Leverage multiplied. Assets rose not because productivity improved, but because money had nowhere else to go. Now the tide is pulling back, and we're seeing who was swimming with borrowed time. This doesn't mean collapse is guaranteed, but it does mean fragility is real. Here's the quiet part. Every global crisis reshapes the system, but never fully resets it. We patch, we stabilize, we move on. Each cycle leaves behind more debt, more complexity, more interdependence. The chain gets longer and thinner. The uncomfortable truth is that no one fully controls this system. Not governments, not banks, not central planners. They manage outcomes, not certainty. Which brings us back to you. When your bank sends a notification, when your company delays hiring, when headlines mention global uncertainty, you're not watching separate events. You're watching tension move along a chain that rewards efficiency but punishes shocks, that amplifies mistakes, that assumes tomorrow looks like yesterday. And the real question isn't whether another crisis will happen, it's this: when the chain pulls again, who absorbs the strain next?